So today we're going to be talking about investment grade bonds. And the reason I'm doing this video is because I recently did a video talking about how to become a millionaire with $5 a day. And I talked about investing in a portfolio of blue chip stocks and investment grade bonds. And one of the most common questions I got was, what exactly is an investment grade bond and how do I go about investing in them? So I thought this would be a great video to kind of go through what an investment grade bond is, as well as what a bond is. Give you guys a couple of examples of bond ETFs. Now, a bond ETF is an exchange traded fund. So when you invest in a bond fund, you're investing in a pool of bonds. Any fund you invest in will be a pool of investments. So it could be a mutual fund, which would be a pool of investments. It may be an index fund, which would be a pool of investments tracking a certain index. But if you invest in a bond fund, it's a collection of debt, a collection of bonds. So it's an excellent way to diversify, and it's better to invest in funds to have broader exposure. And that way there is less risk for one individual bond taking down your whole portfolio. So that is why if you're going to invest in bonds, I highly recommend using a bond investment fund. And the easiest way for most of us to do this is with an exchange traded fund. An exchange traded fund is a way to invest in funds like a stock. So you essentially would invest in an ETF the same way you invest in a stock. You type in the symbol on your trading account and you buy individual shares of the fund just like you would buy shares of a stock. But I'm going to give you guys some examples here, and just so you know, before we go any further, I am going to explain the actual process of grading a bond and what is an investment grade bond and what's considered junk bonds, which is something many people don't understand. So you'll have a leg up on a lot of people when you understand the actual ratings of debt and the credit ratings of bonds. So that's the next thing we're going to cover here in this video. But first I want to basically tell you guys some examples of bonds. And all of these here are considered investment grade bonds. That'll make more sense when we talk about bond grading in a minute. So a bond is a debt security or an IOU. Basically, the borrower issues a bond to raise money and investors lend the money for a certain length of time. And the longer duration of time, the higher risk the investment is. Now understand that with risk comes reward. So when you have a higher risk investment, that's going to command a higher interest rate. So that's why when we're looking at these individual examples, you will see the longer term investment funds are going to have a higher rate of return. Because obviously the shorter amount of time they have to repay that cash, the lower risk it will be, and it will be more likely that they will repay without defaulting on their obligations. We're going to cover defaulting in the next part of this video, so if that word doesn't make sense to you, we'll talk about that in a minute. But there are three groups that issue bonds. We have corporations, we have governments, and we have municipalities. So first, let's talk about corporate bonds. This is basically when a corporation issues debt and the borrower basically funds that debt or funds whatever it is they're looking to raise money for a certain length of time, and then they get a certain rate of interest for giving them that money to do whatever it is they want to do. So I highly recommend Vanguard because they have the cheapest expense ratio of most bonds and most funds that you will find out there. There are other ways to invest in bonds. A lot of people use iShares. I'm partial to Vanguard, so all of my examples here are going to be Vanguard. But if you want to shop around and look at expense ratios or look at the credit rating of different bonds in the fund, I encourage you to do that as well. But for these examples, we're going to stick to Vanguard because many people exclusively invest in Vanguard funds, me being one of those people. So first, let's look at corporate bonds. So we have a Vanguard short-term corporate bond ETF. And this trades under the symbol VCSH. So this is an exchange traded fund. So you can open up your trading account right now, type in VCSH, you'll find the short-term corporate bond fund, and you can invest in that fund just as you would ordinary shares of a company. Then there's the Vanguard Intermediate Term Corporate Bond ETF. This is under the symbol VCIT, and if you guys haven't caught on yet, it's Vanguard Corporate Intermediate Term, Vanguard Corporate Short Term, and then there's the Vanguard Long-Term Corporate Bond ETF, which is under the symbol VCLT. Now, this is basically the return of that investment since inception, and in red is the return over the last 5 years. So as you can see, the shorter term fund has a lower interest rate. It has a lower rate of return over the last 5 years, and as you have longer term, you get a better rate of return. So when I was talking in that video, I said historically investment grade bonds over the last 100 years have paid on average 6%. As you can see, it's very possible to get a 6% rate of return on an investment grade bond fund. So for our example here, you might want to consider the Vanguard Long-Term Corporate Bond ETF, which is available through an exchange traded fund. You buy it like ordinary shares. Then we have government bonds. This would be U.S. Treasury bonds. And we're going to talk about this later, but Treasury bonds and government bonds are exempt from bond rating because these are the bonds of the highest quality, and there is virtually no risk of them defaulting, because if a government defaulted on their obligations, that would basically be the end of the government. So they're good on their money. They're good on their debt. They're not going to default on their obligations, because if they did, we probably wouldn't have a country anymore if we were not able to pay back our debt and we defaulted on our obligations. So government bonds and U.S. Treasury bonds are the bonds of the highest quality, and as a result, they have some of the lowest rate of returns because there's much less risk associated with these bonds. So through Vanguard, you could invest in the Vanguard Short-Term Government Bond ETF through the symbol VGSH. There's the Vanguard Intermediate Term Government Bond ETF, and then the Vanguard Long-Term Government Bond ETF. And as you can see with the symbol, the VG is Vanguard Government, Short-Term, IT for Intermediate Term, and LT for Long-Term. So as you can see, obviously the longer the term is, the better the return is on that fund, and a short-term government bond pays very little. So there we're seeing 0.8% return on that fund since inception, and 0.56 per year over the last 5 years. So obviously, that's not a very attractive bond, but the long-term government bond since inception has paid 6.55, but 2.74 over the last 5 years. So if you're looking for that 6% range, this is a lower risk, obviously, but the return is not as good as you might see with a corporate bond. And then the final one we have are municipal bonds. So municipalities will issue bonds called municipal bonds, and there's only one municipal bond fund available through Vanguard. You might be able to find others through iShares or some other bond fund out there. But theirs is the Vanguard Long-Term National Municipal Bond ETF. That trades under the symbol VTEB. Since inception, it has paid 3.05%, and I believe this fund was created in 2015, so there was not a 5-year return because the fund hasn't been around for 5 years. But what people like about municipal bonds is the fact that the interest income from municipal bonds is free from federal income taxes, and most states exempt them from taxes as well. So that's a great advantage to municipal bonds, and many people who are looking to lower the amount they're paying in taxes would love to invest in municipal bonds because you don't pay taxes on the interest that you get from those bonds. Whereas these bonds here, the government bonds and the corporate bonds, you're going to pay taxes on the interest you earn from those investments. But for someone looking for investment grade bonds, this is 7 examples of great investment grade bond funds. Okay, so now we're going to talk about bond rating. And I know this looks like a lot. I know at first it made my head spin, but once I go through and explain it, it's really quite simple. There's 2 major rating agencies out there, and they each have a different way of rating it as far as a letter assignment to their quality of the credit. So we're going to show you what the Moody's is, and as well as the S&P credit rating, just so you can determine what is an investment grade bond and what's considered junk bonds. Rating agencies assign a risk of default to corporate and municipal bonds. As we said, treasury bonds, those government bonds, are exempt because those are considered to be of the highest quality and the lowest risk of default. So above the AAA S&P and the AAA Moody's rating would be these government bonds because they are even higher quality. These are the bonds of the absolute highest quality, are those treasury bonds. Now, default would mean a failure to fulfill an obligation or bad debt. So if someone defaults on a bond, it means they are unable to repay that debt, and it is now bad debt. So basically, there's a Moody's rating, and then there's the S&P rating, and they correspond here with each other. So a AAA in Moody's is a AAA with the S&P. This is the highest quality and the lowest risk. And then we have the AA1, AA2, and the AA3, and one of those A's is lowercase there. That corresponds with a AA plus, a AA, and a AA minus for the S&P. So instead of using the plus and the minus, they use a 1, 2, 3 system with Moody's. Now these are high quality bonds or high quality investments with slight risk involved. Then we have A1, A2, and A3, which corresponds with an A plus, A, and A minus with the S&P. This is a great quality investment, but not of the highest quality of the ones above it. Then we have BAA1, Baa2, and Baa3, which corresponds with the BBB positive, the BBB, and the BBB negative, which is a medium grade quality, and this is the last group that's considered investment grade. Everything below this is now considered junk bonds or bad investments. Some people invest in junk bonds because these are bonds that may be okay, the debt may be okay during good economic conditions and good economic times, but if we turn into unfavorable economic conditions, these groups are at a higher risk of defaulting on their obligations, especially when you get into the C's. These are bonds that may be okay during prosperous economic times, but if we have bad times ahead, then they may be at risk of defaulting. So now we have the BA1, the BA2, and the BA3, which is the BB positive, the BB, and the BB negative. This would be moderate quality. Then we have the B1, B2, B3, which is the same as the B plus, the B, and the B minus for the S&P. This is what's considered not an attractive investment, but some people do still invest in these because you have to understand as the quality of the credit or of the debt decreases, it commands a higher interest rate. So the bonds that fall into these categories below here, or investments that fall into these lower credit rating qualities, are going to command a higher rate of interest. So some people are looking for high risk and high return. They may be somebody who are looking into junk bonds. Then we have the CAA1, the CAA2, and the CAA3. That corresponds with the CCC positive, the CCC, and the CCC negative. These are considered to be poor quality investments. Then we simply have the CA or the double C. This is a very poor quality investment. And then we have the single C, which is the same across the board. This is the absolute lowest credit quality a bond or an investment can receive. And then we have the D, which is under the S&P. They don't have one that corresponds with Moody's, but this is an investment that is already in default. So this is a way to determine the quality of an investment. And I drew this line over here just so you guys could see. These four tiers are considered investment grade bonds. Everything below this is considered a junk bond. So if you're looking for investment grade bonds, you need to find a bond with a credit quality of BBB minus or higher, or a Baa3 or higher, depending on which rating agency you use. So that's basically it, guys. That's what investment grade bonds are. This is how bond rating or credit rating works. And now you understand where to go find investment grade bonds. You can invest in them through an ETF and buy them like a stock. And now you're empowered with all the information you need to go out there and look into some investment grade bonds. So I hope this answered a lot of the questions you may have had. If you guys enjoyed this video, please drop a like. And if this is the first video you're seeing on my channel, I would be surprised if it is. But if it is, make sure you do subscribe. I do videos talking about topics like this every single day. And I thank you guys for taking the time to watch this video. And I hope you have a great rest of your day.